Hello and welcome back. So, if you're like me, you enjoy discounts. And so, when I'm looking at the stock market, I'm always trying to find stocks and companies that have some great value and are producing great results with their sales. Yet, their stock price is not reflective of what they have been doing when you actually account for the whole market and how the whole market is acting and kind of overvaluing the other stocks and a lot of them at least. And so today I wanted to take the time and actually take a look at Intel. And previously I examined AMD, which is a competitor. And in case you haven't watched that video and you're interested, take a look at the link that I have added on the top right of your screen. And I'm going to be examining Intel and I'm going to tell you why it's on my shortlist for purchasing probably very, very soon. I like what I'm seeing here and I want to tell you why I like what I'm seeing here. Now, first off, how do we always start our assessments of companies? We initially take a look at the market cap, which is $217 billion, which is a lucrative market cap for sure. It's an expensive one. And then we take a look at the outstanding shares, and I love the story here. I absolutely love that. So Intel used to have 5 billion shares here, and now it's down to 4 billion, which is an insane decrease, and it's amazing because it actually gives value to the current stocks if you're actually holding stocks right now. So I'm not really looking at the price action in order to determine value of a company. I'm looking at the company's financials and I'm looking at the company's facts and what they are doing with their stock, how they are rewarding investors. Now, Intel also has a 2.6 dividend yield, which is very nice as well. Like this is a pretty nice dividend, and we will examine the payout ratio later, and we'll take a look at it in detail. But if you're holding this stock, and maybe that's the reason why it hasn't been flying too high, you're also getting a pretty nice dividend, which is also very nice to see if you value that extra income. So let's start by taking a look at the income statement of the company, and you will notice here that despite the lack of growth, and you would kind of expect that from such a massive company which has like a $200 billion market cap, although you would still like them to grow a little bit. The thing is, when the company is making cash flow and free cash flow, and they keep that free cash flow and invest and basically create a bank and improve their balance sheet, then the whole value of the company increases. And even if you don't see that growth, you do see the value, and you have to see the value, and the company is still worth a lot. So don't just be posed to find growth necessarily, although it's always important, yes, but it's not the only thing to look at for sure. And yeah, you will notice that there is a little bit of decrease, I guess, and a little bit of, I guess, steady growth or lessening growth. But we want to examine what's going on with like net income here. So, for instance, you will see that 2017 the company had 9 billion, and then it massively grew to 21 billion, and then kind of stayed there. So it's hovering at around 21 billion. Yet it's not going down either. It's about the same level. So you don't really see the customers rejecting the company. It's just that the company doesn't seem to be growing that much, and maybe that has to do a little bit with the extraction of dividends, like the payouts to investors. But investors, I'm pretty sure they like that, and they are also have like part of ownership of the company. So I guess that that's good news for most of them, since the company stock price is also doing pretty well. So over here, we take a look at the company's assets and the total current assets of the company, the ones that can be liquidated in 12 months, in a short period of time, are growing and growing nicely year over year. And likewise, the total assets also growing. And you will see here that the total equity of the company, which is what matters in the very end, is it was 69 billion in 17, and it's like 90 billion in the current last 12 months. And so this showcases that the company's balance sheet gets improved, it gets better and better every year. And so that's at the end what you really want to see from a company. Let's take a look at the cash flow. So cash flow here, you will notice that cash from operations keeps increasing, and I love to see that. With this, like the last couple of years, it has been kind of steady, but still, I mean, it's not decreasing. At least it's not decreasing much. It's about the same level, 33 to 35. So I'm fine with that. I like that, the cash from operations is plenty here. And let's take a look at the cash from investing. A company spending a few $1 billion for acquisitions, which is nice to see, investing in the market. And these are generally speaking all very positive things. And likewise, you see here that cash from financing is also in the negative, which is another good thing to see, because the company is paying back debt, it's repurchasing stock, and I absolutely love that part. Because if you know that if the company, if you get into this company, it's likely that they will keep repurchasing their own stock. They believe it's a good value, and I agree with them. And also, it's beneficial for investors. This is rewarding investors for holding the stock. So this is a potentially a very very nice long hold company, basically a company to hold for the long term, just because of the fact that they are making good money and they are actually repurchasing their own stock, so removing stock from the economy really, and so increasing the value of the current stock and the stock that you already own if you own it. And the free cash flow here from 10 billion in 17 to 17 billion in the last 12 months, which is awesome. A little bit of slow growth here in terms of the cash flow. It actually went down a little bit, but I'm fine with that. Again, this can happen. Not a huge deal if it happens for 1 year, and when you compare it to the previous years as well, I mean it's still increasing. So I wouldn't just necessarily be too cautious about that just because it happened in the last 12 months. So it could also have something to do with COVID as well, for sure. Let's take a look at solvency, which is the debt. And the total debt to equity of the company is slightly increasing, but it's still in normal levels. I would like them to remove a little bit of the debt, maybe bring it down to 35 or so. Would be nice, like about these levels over here, but this definitely doesn't really pose much of a risk to my eyes. I think Intel is just fine, and they have a lot of cash as well to use it for funding debt, and so that's probably fine. And let's take a look back at the cash flow here, and examine the cash flow in comparison to the stock price. So let's take a look at the cash flow. So the cash flow, and let's use our calculator to determine that. So 10 billion for the first year, and I'm looking at this value here, plus 14, that's about around it over here, plus 17, plus 21, plus 17. So that gives us a value of 79, and that's basically the total cash flow, 79 billion about, that they have made in these 5 years. And let's divide it by 5, and we get 15.8, which is the average amount of free cash flow that they have been making every year. And so we want to use this 15.8 value to extract a multiple from the current market cap. So if we divide 217.3 to 15.8, 217.3 divided by 15.8, we get a value of 13.75, which is a multiple of the free cash flow. So the current market cap is a multiple of 13.75, which is very very fair for a company like Intel. And I guess I want to try to find companies that are below 20. And you could say that just because the company does not seem to be growing that much, we want to give it a lower multiple, and I would agree. But I already still like the fact that Intel is making a boatloads of money in terms of its free cash flow. And so even if I was given a 20 multiple, I would be fine with that. And so at the current level of $53.44, I would buy the company. And I'm actually, as I said in the very beginning of the video, I'm about to buy it. I'm thinking of buying it in the next few days or so. I think it's a pretty great opportunity right now, and I feel it has a lot of room to grow for its stock price. And plus, I like the fact that they're paying out dividends. And apologies, I forgot to talk about that. So it's another great part of it, the fact that the payout ratio is 26.4, which is very very healthy for a dividend payout ratio. I mean, there are companies that have like 70% or 60% that are very very well known as well, very very well known brand names. And so 26.4% is almost nothing. I mean, this is nothing to fear. And you will also see that the dividend payments here have been increasing and increasing and increasing year over year, so they look kind of safe. So I just don't see how I could go wrong with entering Intel right now. Looks like a very nice opportunity for me to enter, and I'm looking to buy that stock very soon for my portfolio. Hope you enjoyed the video, and if you did like this video, you may want to take a look at the last video that I make, which was in which I was talking about Alibaba and its potential for explosive growth in 2022, which I think has a lot of chance to happen. And thank you for watching this. If you did like it, please subscribe as well, and I'll see you in the next video. Bye bye.